Gold is down this Monday after coming close to 1376 in Asian trading. Is this just some backing and filling, or could the safe haven bid be waning? Joining us now is Peter Hug, Kitco's Global Trading Director. Peter, good to have you back on the show.
It's good to be here.
So, Peter, what are you making of gold's weakness this Monday? It managed to come close to 1376 resistance level after backing down. Does gold still have the potential to break through here, Pete?
I remain constructive on the gold market after Friday's move with the blowout employment numbers. It gave traders an opportunity to buy at significant support levels down at 1338 and silver down at 1925. It was an absolute gift to traders. Anybody that managed had the fortitude to buy into that market. We suggested they hold it through Sunday night, and last night we got the test of resistance close to 1376, which was the exit point. And then the news that came out after that was, the Japanese Prime Minister won with a landslide, brought the Tokyo stock market up 4%. That rolled into Europe with higher equity prices and rolled into the U.S. with higher equity prices this morning. Took a bit of the fear edge off the market, and so there's some backing off from the highs we saw last night at the Asian Open.
So you mentioned a few reasons here why gold is under pressure. Does it also still have to do with the fact that the market is still digesting Friday's better than expected jobs report here?
Again, I thought the number on Friday was irrelevant. I expected a better number than we got in May. I did not expect a 280,000 print. My number was closer to 180, 200. But again, I think the number is totally irrelevant. I cannot imagine the Fed is going to move given the uncertainty that is surrounding Brexit and some of the European issues, especially with the Italian banks. So I think the Fed stays on hold. I think the employment number was a psychological number that scared people into thinking the Fed might still have a rate increase on the table come a couple of weeks from now. And they panicked and they sold into the market, which gave an opportunity for people that had missed this move to enter at much lower prices.
Some analysts still saying that any downside in gold presents buying opportunities. What would be a good time to get in here?
Well, again, I'm still solidly constructive this market unless we lose 1338 on the downside. So, I mean, if you're not engaged in the market yet as a trader, right now we're in neutral territory in the mid 1350s. If you're not invested in this market from an investor's perspective as a percentage of your portfolio, I don't think it's a bad time to get in here. It's not a bad time to get in at 1400. I do think you need a percentage of your precious metals, of your portfolio in precious metals. But from a trader's perspective, right now we're in neutral territory. We got out last night at the 76-ish print. And if it breaks above it, we're going to be aggressively long. And if it moves back down to the 1338 level, we'll probably take a long position there. But right now we're neutral. And the market could move $10 either way of this current range without necessarily breaking the range.
All right, Pete, just some quick thoughts on silver as we wrap here. The metal managed to hit 2070 overnight, and it's also back down here this Monday. Would you say there's a better trade right now, gold or silver?
I think silver is now relatively fairly valued to gold. If gold breaks 1376, I see silver probably moving up over 21 fairly easily, with 22 being the next target. If gold loses 1338 on the downside, I think you see 19 and a quarter, 1875 on the downside of silver. So I think from a ratio perspective, it's relatively fairly valued against gold. I still think it's a bit heavy against gold. And if gold does break up through the upside, silver moves with it. But if gold doesn't break, silver doesn't move on its own.
Peter, thanks so much for your thoughts today.
You're welcome.
And thank you for watching. We'll see you tomorrow on Kitco News.